Before we jump into this episode, I want to invite you to join our community to help you become a better steward, scale to billions, and ultimately give more or all of it away. All I want you to do is to click the subscribe button right now. I love your support. It's incredible to see your comments, and we're just getting started. I can't wait to go on this journey with you. Thank you so much for subscribing. It means the world to me. Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. And we believe the key to scaling and compounding your wealth in life starts every single day with the mindset and practice of stewardship over ownership. Our ultimate goal is to help you scale and compound your wealth in life so you can give more or all of it away to help MVPs. I'm your host today, Brett Swartz, and each and every episode we're joined by some of the world's best real estate, financial, wealth, and entrepreneur minds in the world, where they share their insights and wisdom with us so we can all scale and make a bigger impact. I'm excited about our next guest. He's out of the state of Georgia, the Atlanta area, and he's in the multifamily investment and single family space, as well as the debt space within housing. And we're going to be talking about the shift from multifamily equity to multifamily debt. He's a repeat guest from a couple of years ago on the Capital Gains Tax Solutions podcast. Please welcome to the show with me, Mr. Daniel Angel. Daniel, how are you doing?
Hey, Brett, how's it going? Nice to see you again. Thanks for having me.
Absolutely. Let's just dive right in. So what would you say is the biggest shift we're seeing right now in the last 2 years? Walk us through your strategy and your new fund. But just before you do all that, but walk us through sort of the change of the guard, from the multifamily equity to more of the multifamily debt.
Yeah, of course. And definitely we can talk about what has happened in the past couple of years, not foreign for, I think, anybody else in this space. We had been focusing a lot of our, pretty much 100% of our efforts in multifamily acquisitions, value add, with everything that has, happened in the past couple of years, disconnect between sellers, buyers, cap rates, interest rates, everything that we all read about, hear about, and live through. Definitely one of our main objectives for our investors and for our teams is finding ways to keep finding opportunities. Our inception came from the single family space, so that was one of the reasons why we decided to get back there, see what we could do, either same or different, and we got to development in that space, or ground up construction, both for sale and for rent. And then from the transition from equity to debt has to do a little bit more from a structural perspective than from what we're doing on the ground, really. And it's just trying to find a little bit more certainty for our investors, where, the typical deal by deal, either JV or syndication structure, and investors or passive investors getting into the LP space and being exposed to a single asset versus being in a fund and maybe via a debt structure where we have more certainty. The fund gives them more flexibility and diversification. So we just found that route as a good avenue to give our investors alternatives to preserve wealth and have more certainty moving forward.
Okay, so stick with Daniel Angel here, everybody. You can go to apexinvestments.us. That's apexinvestments.us. So you guys opened up this fund, diversified real estate portfolio, fixed returns. Obviously interest rates have gone way up. We thought they might be lower at this point, but they haven't yet. We'll see. The latest was that they're going to keep the rates the same. There was no increase or decrease, and so it's sort of like wait and see again here. It seems like, Daniel, those whose debt has reset and has adjusted, people are fine. I call it the jujitsu multifamily tap out. They're finally okay, I'm just going to tap out. You know what I mean? Like they had him in an arm bar in 2023, but they got out of the arm bar. They had him in a choke in 2024. And now they're in a triangle, and it's just it's over. And they're just giving the keys back to the bank. I mean, what's your take on where we're at with people that are finally just Okay, rates aren't coming back down. I can only extend and pretend for so long. So if you like this little short clip of the interview I just did, click over here to watch the full interview. And please don't forget to subscribe. Thanks so much, everybody.